outlook. Let's welcome our featured guest of the morning. He's Jeff Hull, Senior Wealth Advisor at Manulife Wealth. Jeff, first of all, thanks for coming in.
My pleasure.
These are both, Fedex in particular, and Nike as well, are both closely watched companies. Neither one of them has a lot of joy for investors today. What do you think of these, these outlooks?
With Nike reporting its revenue decline of 9% and all the overhang and the dark clouds of potential tariffs because of Mexico and obviously other areas as well, depending on where Trump, April 2nd, is going to start to create his tariff tirade. It's going to really weigh on companies like Nike, but also on FedEx as an example. They got the same problem. Like the unknowns of the tariffs is where are they going to be? What countries? How's that going to be factored in? People also forget there's a cost with certain extra handling of things to get things cross-border. Sometimes you have to have shipments that wait a lot longer and trucks idling, and there's a whole bunch of other costs people forget about. One benefit for FedEx, though, that wasn't really delved into in the report, has more to do with the cost of fuel coming down, both for jets and transport trucks. That could be a benefactor there. But they also lost their contract with U.S. Postal Service as well. That expired, so that's also going to continue to hurt their math as well.
Nike is perhaps a more company-specific story. It, for a long time, has had an inventory build that forces it to sell off a lot of inventory products at discounted sales. But it does also sell its products all around the world, and it's citing upward pressure on inflation and a weakening consumer environment.
Yeah, and it's also tricky. From one thing that they have a problem with that others don't is Nike usually doesn't sell direct as much, so they're going through a third-party seller. So that third-party seller takes part of their margin away. Where a company like Lululemon that controls all of their stores, as an example, they get to earn their entire margin for themselves. They can kind of control and right-size their business a little bit easier. Versus Nike just got that seller that's in between as that third party. That makes it difficult, especially on the retail side.
Is there a takeaway for investors here who have watched stocks on an index basis decline for the better part of this year?
I think more than anything, it's about finding the right business and the right company. For instance, someone really wanted to be in athletic apparel companies is look at Nike, but look at all the other competitors as well and just try to find the business that's right. But also know there's sometimes hidden companies that can benefit behind the scenes as well, whether it's a Nike or a FedEx or others, or even Amazon, who makes their boxes, who makes their bubble wrap. So there's always the hidden partners and distributors behind the scenes that sometimes people just forget about because they're out of sight.
Would you buy either one of these stocks? Both of them are trading at 52-week or longer lows.
Yeah, it depends on the individual investor, but for myself, I do not buy either of these at this time. I think there's both better companies in both of these areas people should possibly consider, but I'd rather be in a totally different area. I don't like areas that have margin compression, as an example, but overall, big businesses, but they have difficulties and storm clouds ahead with those tariffs.
That is Jeff Hull and his take on our top story, two corporate heavy